Delinquency rates are the canary in the coal mine for financial health in this business. If you're lending out money that people are not paying back, clear as day, you got a problem. And if the economy is going south, people are losing their jobs, that's not a unimaginable scenario.
Welcome, everybody, to an emergency podcast the day before Thanksgiving.
The SoFi app had a really big update. It forced everybody on iOS to update, which is odd because sometimes you could still use your banking app if there's a new update and you could just update it at night. And it feels faster. Finally, like the SoFi app actually feels a little bit more usable.
If it pushes you out of the app and then you have to re-log in again, number one, and then if you have to force update the app, those are indications that there's a really big change from a backend perspective. That doesn't necessarily mean that your user experience is going to be different or the app is going to look different. If it's a forced push, then it's generally something to do with like their database or how they're handling the user authentication and stuff. So if it's getting faster as a result of that change, I wouldn't be surprised at all because all the signs point to some backend change. Can we jump into the crypto stuff?
Just to clarify on that, I am going to be playing the devil's advocate in this situation.
What happened was members of the U.S. Senate Bank Committee on Monday, they wrote an open letter to Anthony Noto. So in that letter, they basically highlighted a couple of areas of concern around SoFi's specific crypto activity. Some of the conditions of the bank charter, which SoFi gained in January of 2022. As a result of gaining that bank charter, they were under way more scrutiny. And SoFi had 2 years to basically divest out of their crypto business. However, the concern comes that instead of divesting and ramping down that business, SoFi actually increased or accelerated that business. In addition to that, the senators also highlighted in their letter some risk requirements, basically asking SoFi, okay, how do you determine risks? And are you actually doing any financing with crypto? So basically after FTX blew up, everybody's on high alert with regards to exposed risk. SoFi, they responded right away to this letter. On Monday, they released a thread on Twitter. They also released an 8K that expanded on this point. Their stance was this: we've been perfectly in compliance with all regulation. We do not have any financing activity, so we don't do any leveraging. All we do is we buy, we sell, and we collect that brokerage fee. The actual revenue from crypto is less than 1% of total revenue. It's like 3.85 million was their total brokerage fees. Of that, crypto is a portion. So less than 1%. And we're perfectly open to have that conversation. They actually were welcoming it. They're like, hey, if you want any other details, like let us know. Because people always jump to the nuclear option of like, is SoFi going to lose their bank charter? But in my opinion, I think it's absolutely a nothing burger because it's going to result in some type of conversation with this committee. It might result in SoFi having to shut down that crypto business at the very worst case.
I would say that the absolute worst case is that our conditional bank charter gets revoked. It's a conditional bank charter. We haven't even really been set with a real bank charter. We're allowed to operate under a bank for now, given the fact that we hold up to these conditions of divesting from SoFi digital assets.
Okay, so let's say in theory, the worst case is they lose their conditional bank charter. Realistically, they'll never get there because, first of all, it took them like almost 2 years to get it. A lot of scrutiny had to go into that process. Worst comes to worst, there's going to be some ultimatum where this committee is saying, hey, either divest in crypto or we're going to remove your bank charter. They're just going to divest your crypto.
I didn't like the response. I felt like they were skirting around the issue and not talking about the 3 issues that were talked about. So the 3 issues were SoFi is expanding its business in crypto when they should not be. Secondly, that they facilitate customer activities and allow people to buy and sell with crypto, even though we might not have the capital requirements for that. And thirdly, we let people buy dangerous tokens and securities. What SoFi went into in their response was, we don't have any direct exposure to FTX. That wasn't part of the letter. We don't do extra lending transactions with crypto. We keep it very safe. There is some good points in this letter.
We had this crypto offering before we became a bank charter. Only thing that has changed was SoFi said, hey, if you want to set up direct deposit with us, we can allocate some of your direct deposit to crypto. We're going to make sure you don't have to pay any fees on buying that crypto. Whole reason this thing came about is because of FTX. These 4 senators, I don't know who they are, and I don't like to get political, but it sounds like they're kind of opportunistic.
Just because they were opportunistic and actually took really, really good chance to go after SoFi, does that make their case wrong? It makes it shady, but they could still have a case.
A large portion of this is virtue signaling from a lot of these senators because they want to be seen having a hard stance on this stuff because a lot of people lost money in that FTX blow up. It really is a focus area, at least in the letter, because they start off the letter talking about FTX and how that blew up. And then question number 1 was, do you do any other financing activities with crypto? Is it just buy and sell brokerage fees? That's why SoFi in their thread addressed FTX, and second of all, addressed how little money they actually made from fees. And they said it's only brokerage fees. We don't do anything else.
Problem is I didn't find that they really addressed the expansion part, which I think was the big smoking gun. Do you guys think it's an expansion of crypto? Do you think it's a new service or offering?
The direct deposit thing?
Yes.
I don't think so, because like you could buy and sell crypto whenever you downloaded SoFi before the bank charter, and you could do the same now, but you have a different way of doing it. Is automating crypto purchases like that big of a regulatory issue?
SoFi's own wording, and this was addressed in the letter, they said the company's public billing this service as the latest expansion of SoFi's offering to make it simpler to get started with cryptocurrency investing.
If we just follow this rabbit hole of like the bearish case, it'll probably lead to some back and forth discussion. Either we divest from crypto altogether, in which case we still have 2 years to divest from crypto. Like no drastic action is going to be taken to the downside of the bank charter in the next 2 years. We've only been having the charter for 9 months. So either that's the route, which is negative for SoFi, of course, because crypto is one of their offerings, or we have some type of arrangement with the Senate committee to include that crypto offering as an exemption included in the bank charter. And so both routes are seemingly insignificant when you go to the nuclear option of like they'll lose their charter.
Problem is that we were already told to get out of crypto in January 1st, 2024 is the exact date. What if we did something wrong, which wasn't part of the condition early? It expanded our service. And does that mean we're still on track for January of 2024? Or does that mean they put down a hammer and say, you know what? I don't know how big of a slap on the wrist it's going to be.
The rest of the crypto world is burning to the ground right now. We're caught by proxy.
They have plenty of time to get to that resolution. What is the actual thing that they did wrong? But what supposedly sparked this was the fact that they offered basically an automation service with regards to that direct deposit. In my opinion, that's not a new product. Like it's not like, oh, we introduced 30 more shit coins for you to invest in. It's just like, hey, you're already doing it manually. Here's an automation.
And so
Approval
if
to
the
be able to work
FTX
with
shit
crypto.
didn't happen, you'd think these senators probably wouldn't have cared.
Yeah, because I mean, they mentioned it in the letter.
There were 3 conditions for SoFi's bank. That was one of them. So it's not insignificant. This was one of the 3 rules to make our bank charter actually hold up.
In 2021, I think Lending Club and Square both received bank charters, either 2020, 2021. So where's their letter?
Well, Lending Club, I don't actually know if they deal in crypto. Block doesn't have a bank charter the way that SoFi has a bank charter. They have a loan approved bank charter. They can't do what we can do on the financial side.
I think it comes down to one simple question. Sorry, I'm almost done. Did Anthony Noto and the leadership team talk to the regulators before they did the direct deposit thing? I don't see a world where they spend 2 years trying to get this bank charter and then they're playing around pushing the envelope of what they can do.
Right. And so that was definitely the best retort that SoFi said, is that they've been in constant and concise conversations with regulators the whole time. Another part of this is that SoFi is offering unregulated and dangerous tokens and securities. What I will say is that the company's policy on cryptocurrencies, this is SoFi's company policy. In order for them to be listed, they have to align with SoFi's values, such as promoting financial inclusion and economic freedom. In one of the tokens that is listed in SoFi's digital assets, they call it, word for word, a crypto pump and dump, and has no special use cases or features. So this is one of the other parts that the senator brought up, saying that SoFi is just being a little bit shady in the way that they're promoting these tokens.
It is almost guaranteed SoFi is going to be running into regulation. If you go through the home feed, they show all their products. They do all this cross-selling and they kind of advertise within the app.
It's totally normal and expected, guys. But here's the thing, though. I think that a lot of these regulatory bodies are very disjointed and have little communication. That's a bias on my part. I guarantee you that SoFi, the reason why they put, hey, we've been talking to regulators all along, is because they've guaranteed checked this. If that's a huge part of their offering and their business, they're not going to make marketing materials or content to promote crypto side of their business if they're just going to divest in 2 years. I mean, just thinking logically, it doesn't really make sense. My bet would be that they've already gotten the green light from some regulatory body. In other words, it's going to get resolved in a conversation format. Maybe they just remove those coins that have no utility. Ultimately, I still think that, again, nothing significantly material to the business will come of it.
Let's move on to
student loans.
Basically, the entire crux of the issue was around the legitimacy of whether the administration could or could not make the moves that he did. Federal judge out of Texas, the 8th Circuit District Court of Appeals, all they were arguing was that the HEROES Act, which Biden drew the funds from, he did not have the approval required in order to make that judgment call alone, that he didn't necessarily go through the right channels to do that. The majority of this issue is regarding the actual loan forgiveness. Where this catches us is the second part of that announcement, which was made all in one announcement, which was the student loan pause that was supposed to resume in January now got pushed back to June because this whole issue is going to the Supreme Court. And so essentially we have to wait until the Supreme Court decision in order to resume student loans. But this is, I think, the 9th official pushback of student loans. This is why Anthony Noto last week in the city conference was shaky in terms of his confidence level of this resuming in January. I think the bear case is also, if we're going to be beholden on a Supreme Court decision, I don't think it's going to be June. I feel like that Supreme Court decision is going to get pushed back. And now we're actually beholden on this decision to resume the loan forgiveness.
Whenever asked whether he thought that the student loan moratorium gets pushed or not, he said, whether student loan moratorium gets extended or not, we're going to deliver really strong growth if we're in an economy that we expect it to be, which is a little bit more dour than today, but hopefully not overly dour. He knew this was coming. If it was so finalized, why would he even talk about it being extended at all? He's definitely heard chats going on. This has been going on since March of 2020.
March of 2020, June 2023, over 3 years.
Our business is still great, and we're still getting very close to tangible book value.
Anthony Noto said we're going to do fine in 2023 with or without it, because personal loans is a good business because they have good margins on that business in 2023. Student loans, obviously, it was a massive positive if they can get it back. But even if not, last week on our pod, our guest Stephen basically said that if it gets pushed 6 months, it's fine. If it gets pushed 12 months, it's fine. All it's doing is it's delaying time to SoFi's inevitable growth. Student loans is still a fundamental part of their business. They're still going to be offering student loans. People are still going to college. They'll still be going to college 5 years, 10 years from now. They'll need to refinance those loans. And so all it is short-term bad news because it delays the amount of time until we can actually go up. I think in the very short term, most direct impact is how big that refinancing boom will be in Q4, because last time the refinancing contributed to our best ever quarter, Q4 2021, because student loans were pushed back late in December. Whereas now they're pushed back in November. So we have a full month and a half, like 6 weeks essentially, to negatively have our refinancing affected.
I wanted to highlight this thing from the chat because I think it's super important. Kris says having so many personal loans on the balance sheet is not good. He said the bigger question you should be looking into the growth of personal loans.
I'm seeing a couple things in the chat that I want to address. They do make private personal loans, so someone asked that. Another thing that's brought up is securitization. Securitization might be the largest tool for correcting a balance sheet whenever we find ourselves in a hard time. SoFi just recently got the ability to be able to sell asset-backed securities onto a public market for fixed income purchasers to actually buy, like institutions, trust funds, these things. The idea is that once we sell it off, it goes off our balance sheet. We get cash in return. We deal with some of the highest end clients. SoFi's ABS product got rated at a AAA. So we are far from any sort of credit crunch that's going to happen, and we will be the last ones to possibly get hit. In last quarter, student loan FICO scores were 771. Home loans was 747, and personal loans was 746, which is all considered a prime customer.
We're also going to have to touch on SoFi being at the lowest valuation ever in its entire.
We're waiting for Kris, but maybe one of you can give the high-level explanation for why these FICO score, why he tweeted this. He said, growth at any cost, even lower credit quality standards is not a good look. It's small, but it's still not a good look. If the macro goes south, at what point do people default on their loans and SoFi goes bankrupt?
I think it's a good point, is that two different sides to this argument whenever I look at SoFi. And what I always like to balance on SoFi is there bad news in this company? I'm also not saying that there's no problems with SoFi. Any stock that's being held at this valuation obviously has its problems. The main thing is that the problems that SoFi is holding is not equal to how cheap it's being traded.
Right now, you're seeing the credit card quality of SoFi. So SoFi doesn't exactly have a very big credit card business. So essentially, they don't do as much consumer credit, but credit card debt that is in the higher FICOs is really low. If you look at down at the bottom, it's excessive, right? Especially under 640. So if you're looking at the total origination, almost 25% of the credit card debt that they have is under 640. Anything below probably 750 is not good, and especially during bad economic times. FICO scores at the end of the day are a projection of what's going on today with consumers' credits. If the economy goes south, even if you have a 750 FICO score and you had a $100,000 job last year, that shit is going to drop. The other thing that does make absolutely no sense is, where are these people with high FICO scores going and borrowing borrowing money at almost like 12.25%. Most people with that high of FICO scores, they're going to be doing things like taking out equity loans on their homes, right? Because that's going to give you a much better rate than this double digit nonsense that all these personal guys try to do. I'm not saying that there's any foul play. By no means am I saying that. What I'm saying is their business model is set to be very profitable during good times, but may not necessarily hold up for a recession or an extended recession. This is not a space where they're like one of the few people that are in there. Dude, you get the biggest banks in the world competing to get business. The fact that they're not getting it off their books is bad, because if these things go south, which could possibly happen in the next year, 2 years, what's going to happen is they're going to have to write off the debt.
So this doesn't include personal loans. It's not their lending segment. It's just
No.
credit
No.
cards, right?
Yeah, that's just for credit cards. So this right here is the historical delinquency rate of all consumer loans. So these are the type of loans that you're looking at when it comes to SoFi. You can see here that we are at an almost at an all-time low of default rates, because people who get consumer personal loans are not exactly the greatest creditors. Most people, they turn to personal loans because they're in a hard up position where something happened in their personal life that they have to deal with, especially considering if they're getting loans at like 5, 6, 7 years. If you look at the total amortization, how much money they would end up paying, it would be crazy to have that much interest go out the door.
Okay.
So personal loans are not secured loans. Those are unsecured loans, right? Which means that
Yeah.
anyone in bankruptcy can discharge them. They're gone. There's no collateral backing it. The problem is, if you look at how much of their securitized personal loans were 6 months ago, it was 234 million. Now it's literally $97 million of personal loans that are securitized, that are literally sitting on the balance sheet. The rest, they're just holding a whole bunch of IOUs right now. So if the delinquency rates go up, who suffers? SoFi does.
But let's say, since we were public back in Q2 of 2020, our interest rate that we were giving out has gone up by 1.8%, but yet our delinquency rates have gone up by 0.8%. So we're actually making more on our loans now in a worse environment than we did back in whenever we first went public.
Brother, this is not a worse environment than when you guys went public. Not at all. Trust me.
Okay,
It's
so
yeah.
it at any period in time since we've been public, how about that? We've charged more on our interest rate per quarter than our delinquency rate has gone up. So
Yeah, but the
at our
total
low,
volume, but you guys didn't have that total volume of personal loans, right? You were mostly doing student loans at the time. The shift has been to personal loans. Personal loans, as we know, are not that great. If delinquencies shoot up, you got a problem. Delinquency rates are the canary in the coal mine for financial health in this business. If you're lending out money that people are not paying back, clear as day, you got a problem. And if the economy is going south, people are losing their jobs, that's not a unimaginable scenario. Yeah.
my biggest disconnect is that either people are buying these loans. We're seeing not only more people buying the loans, but more people on a percentage basis quarter over quarter buying the loans than ever before. So it's growing faster and faster every single quarter. So people are buying the loans. So you either have to take a position of they're cooking the books, or
Or a ton of consumers are in bad positions in life. And that means that they're doing everything possible to get a loan so that they can weather the storm. Because if you look at the other thing, which is savings rates have been dropping, credit has been skyrocketing. So if you think about it, most of the people that are probably getting these loans right now, they have no choice. They're like, listen, I need this money just to survive. But at the end of the day, if their economic situation does not improve, they could just declare bankruptcy, and now the entire balance goes on SoFi's books. The one good thing is that the loans are not like crazy amounts. Like the total loans that they give on a per person basis is actually relatively small.
I have the number $24,770 a loan.
When you have like something like 24,000, you have a lot of diversification. Unlike the mortgage side, where let's say you give out a $500,000 loan, they're only giving out 24, which means that now you have a lot more people have to pretty much go default in order to be on the same risk level as someone who was issued a $500,000 loan. The difference is the person with a $500,000, let's say home loan, there's an asset that's backing it. There's the actual home. There's the property. It's based on just credit. Most smart people, especially people with high FICO scores and high incomes, would not go the personal loan route. The minute they saw a 12% APR, they'd throw that shit right in the trash. I actually had a SoFi mortgage 2-3 years ago. And believe it or not, that was actually good. They made the process very easy. It was seamless. I didn't have to deal with too many things. Like the entire closing process was amazing. So I do think the company has something in terms of customer service, but they're chasing growth. And what I don't like like is when a company chases growth and starts to cut corners, that's bad.
If you look at our competitors, they are all doing the same thing. Very close rates, very close delinquency rates, also with bank charters. Look at Lending Club, for example. They charge higher interest rates than we do and still hold up a very good credit score. And both Lending Club and SoFi both have fully chartered banks. So obviously we're being regulated at the highest level. The two biggest purchases that people are doing with our personal loans is debt consolidation. And secondly, they're also doing solar loans. So then people can get increases on their house. There's a difference between high income earners and wealthy people. As people make more and more money over time, they spend more and more money over time. They still need access to capital the same way anyone else would. I mean, obviously their default rates are lower and these sorts of things, but I think SoFi is showing that.
If you are a wealthy person, you have more access to capital than anyone else in the world. Not to mention, most people that are wealthy have assets that they can use as collateral to get amazing loan rates. They're not going to say, let me sacrifice 12% of it to borrow this. What I'm saying is they are doing business based on what's current. They're not necessarily looking at the bad economic times that are coming. Or actually, believe it or not, I think they are. That's one of the reasons why they're trying to get as much depositor cash as possible so that this way their balance sheet can be as healthy as possible. SoFi offers one of the highest APRs on a savings account because they're trying to raise as much capital, because that's how banks work, right? They take money and they lend it out at a higher rate. These guys are lending it out at 12%. They're borrowing at 3% from the consumers. So that's one of the reasons why they're pushing to get their balance sheet as strong as possible, because there could be a wave of defaults coming in the future. So these delinquency rates are the thing that I would say people have to watch out for. Like I said, I'm not saying SoFi is bad by any means, but their business model is not made for bad times. That's the key. When the economics go south, how are they going to manage? A lot of this is going to depend on how Anthony Noto navigates this downturn. If they're able to survive, they could actually come out ahead at the end of it. The question is, do you guys trust this company enough to put your capital and say, you know what? I think this guy can navigate this downturn.
How is what SoFi is doing different from what every single other bank is doing as a result of the macro? If all financial institutions are taking on riskier bets because the interest rates from the Fed are higher, is SoFi doing anything specific that is out of the norm?
Other banks are not doing personal loans at the level that these guys are, where majority of their revenue and income is coming from this specific segment, right? If you look at JP Morgan, you look at the Wells Fargos, you look at these big banks, they have way more diversified business. The problem is the concentration risk, just having so many personal loans. It'd be one thing if personal loans only made up, like, let's say 10, 20% of their overall business, but this is getting to the point where it's becoming so much.
On that chart, we just saw credit cards, and credit cards is a very small offering from an origination perspective compared to personal loans. Is the common conversation here that saying, okay, if credit cards are being offered to 640s, therefore personal loans are also being offered to 640s?
Not necessarily.
Is there a world where credit cards is more risky of an offering than personal loans is?
They're both unsecured debt. The reason why they use credit cards as opposed to, let's say, personal loans is because credit cards, you literally get some level of benefit from using it, right? So it's literally, you do it, you get a percent off, whatever. Credit card companies make money on, not just on the interest, they're going to make money on the fees that they charge the merchants for processing the transaction. Personal loans are way more risky. I don't know, because I haven't necessarily dug too far into what the credit quality of their users are, but based on the averages posted in their earnings, it doesn't make sense. Right now, they're trading under book. If they had such a great business, everything, hedge funds, institutional funds, everyone and their mother would be buying the shit out of these guys, especially if it's trading under book. The problem is people don't have confidence in the book value. If the institutions are starting to buy up SoFi, that's when I would say it'd be a good time to get in. When it comes to Vanguard, BlackRock, and these guys buy for ETFs that they already have. The way that I would say is private equity, hedge funds, if those guys are buying in, that's when you know that, hey, listen, this is something to definitely look at. I think right now, they're the best thing that they're doing, the smartest move that they're doing is raising as much money as possible via direct deposits. These are the kinds of things that SoFi is hoping for, where they can take that extra liquidity that's being provided by depositors and make sure that their balance sheets are strong. If, let's say, things go south and people start withdrawing their money and they don't have enough money, then they're hit by a bank run, it's over for the company. So they need to be as liquid as possible and have as strong of a balance sheet as possible going into this downturn. But one of the key problems with SoFi right now is their operational costs are crazy. Look at how much money they're spending on sales, marketing, and all that stuff. Is Anthony Noto going to be able to cut costs where it's necessary and get through the tough times? Because there will be a time where things go downhill, and we need to make sure that we are well capitalized and we're not blowing money on things that are not going to generate a return. The one thing I'll give Anthony Noto that I don't see other CEOs doing, this dude has been a nonstop buyer. That's confidence. Other CEOs, they're all selling. Anthony Noto could have sold. He could have sold so much, but instead he actually used his personal money and bought more and more shares of SoFi. So I personally would not short SoFi. I mean, when a CEO is buying shares, it's not good for the short. Yeah, and like I said, I like the guy overall. I think the guy's phenomenal. Great orator. Gave an example of his days at West Point when he was on their football team, the injuries he took. So this guy is an experienced operator. The question is he going to be able to navigate this downturn and see SoFi through the end? I do think that there is a possibility, but I'm one of those types of people that even though I go to Vegas, I don't go to the slot machines, I go to the craps tables.
First of all, thanks for hopping on because I really love the contrarian takes. I'm not going to discount that from an emotional perspective. I think it's a solid take. One of the most real bear cases that we've heard on this pod so far.
Look, I love your SoFi content, but just be more skeptical. That's all I'm saying. I do want to say that Anthony Noto, out of all the people that I've listened to when it comes to running a company, the guy seems to have a good head on his shoulders. He knows what's going on. He knows what he's doing. My only thing is he is in a position where he's got to figure out how to weather the storm because every company right now is trying to figure out how to weather the storm. Comments from Anthony Noto in the next earnings are going to be a telling sign where SoFi is headed. So yeah, and it's the same thing with a lot of companies right now. Good CEOs will figure out how to weather the storm and come out stronger. Terrible CEOs will sell their stock, tell you to go fuck yourself and declare bankruptcy, Chapter 11.
All right, raw thoughts after that.
I love having actual like solid logical bear cases though.
Yeah.
I never want to echo chamber, like silo myself into having a bullish perspective on a stock because I'm always like scared that I'm missing something. And so I really love that he was able to actually bring some legitimate concerns going forward.
If you don't get the other side, then you kind of are just looking for confirmation bias and you're not going to realize why your investment went down or something like this.
We're just going to see, I guess, how much these layoffs today result in delinquencies in early and mid 2023.
I think the most important thing for them is to just get on that single core, their ability to be agile and offer different products, whether it be like an investing or like a credit card solution, buy now, pay later. I don't know, but they offer so much more that they have a little bit more leverage in that area. Since our main profit driver is personal loans right now.
Yeah, and look, we know, especially like in the context of the student loan news, that personal loans is going to be the bread and butter going into 2023. And so in my mind, I'm just thinking about like, what does that unemployment rate need to be for those delinquencies to actually manifest? So every layoff that we're seeing in the tech space is pretty concentrated, and it's a lot of bloat that's now being fixed. But when you actually look at the unemployment numbers on aggregate across all industries, then they're still fairly manageable. And so I'm just wondering in my mind how far out we would be from that point of no return.
Right. And like I said, our expected loan losses have ballooned this quarter, expecting another 60% increase in our credit loan losses. And so even knowing that fact, it's not that we're oblivious of the fact that default rates are climbing, but that what percentage is the actual painful spot. And that's really a hard thing to look at.
I think we've established, okay, this is a problem in the macro. And then you apply it to SoFi. How much bigger of a problem is it to SoFi than every other bank? How big does it impact SoFi compared to all their other product lines? And what is the point of no return in terms of that flipping to the other side to actually affect SoFi negatively financially? One of the things that Tannor was saying was like, we're taking more risk with the loans that we're offering, but we're also getting more return for that. And so it's like, how bad does it need to get for that equation to flip on the other side?
Obviously, our financial side does not make up a big portion of our business. I think it went from 8% of our overall revenue last quarter to 11.5% this quarter, but year over year grew like 200% or something along these lines. If options come, that'll go even quicker. It's great to see a bear case, and I'd like some time to almost make a video about this. So he obviously has a point. If the stock is going down, people are selling, capitulating because of these ideas.
Ultimately, I trust in Noto. Again, Kris made a great point about Noto buying. Kris made a great point about Noto being an exceptional leader. I don't think Anthony Noto comes out in a year and says the company is bankrupt. Sorry, I did the best I could. I just don't see that happening.
And also with banks, it really can't happen that way. The Federal Reserve will be very warning to us that problems could arise. You always have to steelman an argument for sure, right? Like, I mean, even if I am a bull of a stock, you still have to go, okay, well, what's the worst that can happen? Because you're going to get caught out if not.
All of us were pretty receptive to what Kris was saying, especially because it was backed up by numbers. I saw a bunch of people in the chat getting really emotionally defending whatever stance they had, and I just think that, again, to reiterate, it's really good to bash your ideas and try to poke holes in them and actually have the other side of the argument, because it makes your conviction way more comprehensive than just blindly being one-sided.
Any last words from you guys? Anything you want to say before Thanksgiving?
Happy Thanksgiving.
I won't be here next week, so enjoy the pod without me. You can get some peace and rest. Probably have a guest who's way smarter, but yeah, all the links are in the description. I'll still, I think, be releasing an edit video on Sunday. I'll try.
Tevis's edits are very legit. His supercuts are phenomenal. It's amazing, amazing stuff.